Well, hi. How are you? I've been waiting for you to join me. You know, I've just been thinking about crop insurance. Are you aware that there are several types of crop insurance policies? Each one of these types of crop insurance has its own strengths, but also its own weaknesses. As you understand the role that each policy type plays in a farmer's overall risk management strategy, you'll be able to strengthen your relationship with the farmers you work with. And each covers different crops and different risks. In this lesson, you will learn about the first and second most common crop insurance policy for organic farmers. Who is it?
It's me, sir, Johnson.
Ah, Johnson, the new intern. Come in, come in.
Yo. Well, okay.
Johnson, welcome. What are you wearing?
Oh, well, I like clothes that make me feel like I'm expressing myself creatively when I'm at work.
Oh, of course, like there's no difference between when you're in bed and when you're at work. This is what the Backstreet Boys did to America.
No, sir. No, I can fix this.
We've got work to do.
Got it.
Not that kind of work.
Oh, okay.
Justin Trudeau called. He wants his Canadian tuxedo back.
I can, no, got it.
Ah, that is much better.
Oh, thank you. Thank you, sir.
Now, Johnson, I think we're ready to talk the finer points of crop insurance.
Excellent.
Are you ready?
Yes, sir.
All right. Well, I would prefer to stay in the cool and classic confines of my office, I think everyone else would prefer a less cerebral environment. Maybe we should take a field trip? Let's hop it. Oh, man. Man, how'd you get here so fast?
I walked there.
Oh, well, at least we landed in this beautiful field of revenue-protected corn.
Yeah.
My, that's pretty.
What makes revenue protection the right choice for all of this beautiful corn?
Oof, I love that question. So you know the saying, dog is man's best friend?
Yep.
Well, the real saying is revenue protection is row crop farmer's best friend. I kid you not. It is the bee's knees for a couple of reasons. So you can have some market movement where price crashes and you can lose money. Or you have a bad yield. Both of those are covered by revenue protection. And so when we think about all of the challenges that face a corn farmer, I mean like bad weather or bugs or weeds or wildlife. So revenue protection. Pretty great deal for farmers, right? It's going to be tailored to the types of crops they grow, protect against yield loss, protect against price fluctuations. I mean, it is so versatile. It's like the Swiss Army knife of crop options.
Wow. Well, that must be it for revenue protection, right?
Well, don't go away. I've got more. So let's talk about the 4 unit structures. Now, we could really go down a rabbit hole if we talked about them all. So let's just talk about enterprise units, because it's usually the cheapest option for organic farmers.
Oh, okay. Well, what's a farmer got to do to sign up for a revenue protection policy?
Ooh, we're gonna break it down. All right. So let's go to Mathland. Come with me.
I don't know. I'm not great at math. I have some.
Now, first is step 1. Are you ready for some math?
Yes.
First is step 1. The farmer chooses how much coverage they want. You can see that they can insure between 50 to 85% of their yield. And you can see that the government pays a different percentage of their premium depending on how much of their yield they insure. Now, here in our example, the farmer chose to insure 80% of their corn yield. So Uncle Sam pays 68% of the premium, and the farmer pays the rest. So those are the options for revenue protection. Now, you still with me?
Yeah, I'm with you. So the farmer chooses how much yield they want to insure, and then what do?
Ooh, then they jump into some math.
Man, I hate math.
Oh, it's
I hate
okay, it's
math.
okay.
I failed math in crop insurance school, and I had all these nightmares. Do you remember the count from Sesame Street? The count would come in, and the count would count off every time I failed. You'd be like, 1, 2, failure, and I just keep hearing it.
That math. That's the math we're about to do.
Do it.
For step 2, the question is, how do we figure the yield at which the farmer will get a payout from the policy? To calculate how low a yield is needed to trigger a claim, we need to find the farmer's bushel guarantee. First step is to get an average of the farmer's past yields, and at least 4 years of past yields are required. If they have never produced the crop previously, they can use their county's T yield. However we get it, this yield average is the approved yield. In our example, the 6-year average on this farm for organic corn is 200 bushels. Since we decided to insure 80% of the yield, we multiplied the approved yield by the coverage level, and the result is the guaranteed yield, which is 160 bushels per acre. Whew, we conquered that math. Feeling good? Feeling good?
I am feeling great.
All right, well, let's exercise those new muscles with a little example. So, we're driving along in our combine. I'm looking at my meter. I see that I'm combining less than 160 bushels an acre.
Oh no.
So I'm gonna trigger a claim, right? That's below my guaranteed yield. But remember, with revenue protection, it also protects against price. So let's figure out what the payout would be for this farmer. And that brings us to step 3. What is the amount I would be paid out at if my yield was below my bushel guarantee? Crop prices are tracked each day in February and averaged into a single price for each crop. This is the projected price for the upcoming season, and the same is done in October. This is the harvest price for that season, and farmers can choose the higher of these prices. I'm scared of this thing now. I'm worried it's all prank calls. Pro tip line. Yeah, my refrigerator's running great. No, I'm not gonna catch it. You get out of here. Pro tip line. Jolly. How you doing? Okay. Okay, thank you for the tip. He says that we should realize that for most crops, there are separate prices for organic, and it tends to be twice that of conventional. Great tip, Charlie. You take care. So if the actual yield is below the approved yield, which we figured was 160 bushels, then the farmer will get paid out for each acre planted to corn, with the approved yield multiplied by the crop insurance price, which you can see here would be $1,875.20 per acre. And that is the farmer's guaranteed revenue. That is why I love revenue protection, because we've got price and yield covered. But there's a little bit of a drawback, because it really only covers your major commodities.
Okay. So revenue protection covers major commodities, things like corn, beans, oat, wheat, the types of crops that have county T yields and commodity markets.
Exactly.
Okay, but what if a farmer is growing a less common crop?
Glad you asked. So remember, if we go back to the second of our 5 major types of crop insurance, whole farm revenue protection, we're going to protect the entire revenue of the farm, not just a single crop against yield and price fluctuations. So let's take a little trip over to my friend Kelda's farm.
All right, let's go.
We're going to see who whole farm revenue protection really works for.
Okay.
All right.
Hi, boys.
Hey, how you doing?
Good. Welcome to Lazy Cave Farm.
Thank you.
Yeah, here we're growing some kernza and strawberries and lamb, and we also have our corn and beans. The kernza, strawberries, and lamb are not covered under the total revenue protection, so I decided to go with the whole farm revenue protection.
Oh, so revenue protection, which is like the Swiss Army knife of insurance policies, ensures yield and market price for individual crops. But whole farm revenue does...
Whole farm insures a farm's total revenue. Instead of yield or crop price, a whole farm revenue guarantee is calculated by making an average of the farm's last 5 years of Schedule Fs and comparing it to the upcoming year's expected revenue, which can be more or less due to expanded acres, different crops, or market prices. The lower of those two numbers is multiplied by the amount of coverage a farmer chooses, and the result is the guaranteed revenue for the farm. And, like the revenue protection you looked at earlier, I get different premium subsidies from the USDA depending on how much of my revenue I choose to insure.
Well said, Kelda. So with whole farm revenue protection, it's really interesting because in regular insurance, we're working on a county-by-county basis. But with whole farm revenue, it covers the entire country. So if you have really niche crops or really normal crops, it can cover it all. And sometimes it's the only coverage out there. I like to think of it as a tarp, like the tarp of insurances, in that it covers everything.
A nice tarp of warm, snuggly peace of mind.
Ooh, I like that.
I've heard farmers say that whole farm protection is helpful because it covers a wide range of crops and livestock, but there are some drawbacks because there's a lot of paperwork and you're not going to get paid out until the Schedule F is filed for that crop year.
You got that right. Another bummer with it is that you have to have at least 5 years of Schedule Fs.
Pro tip line. Oh yes, I would like to order lunch. Thank you. I'll have the lox. Yeah. $18 for some salmon on a bagel? What is it, life-changing? I guess for the salmon it was. All right, now what's your pro tip? Come on. Oh, okay. Oh, okay, I didn't know that. Hold on one sec. I'll tell them. For farmers, they need to know that with whole farm revenue, all eligible commodities on the farm must be insured. You can't just pick and choose just the crops that you want to insure under whole farm. For example, if I grow corn and soybeans, strawberries and lamb, and then I want to insure just the strawberries and lamb under whole farm, and then the corn and soybeans under revenue protection, that ain't an option. It has to be all or nothing. But what I can do is insure all of my crops under whole farm and then also purchase other insurances on some of them, such as revenue protection for the corn and the beans. With multiple policies, a farmer can receive a pretty significant discount. Finally, we're talking discounts. I thank you.
So let me recap this. Revenue protection is good for common commodity crops, and whole farm is good for crops that are not covered by revenue protection or for counties that are not covered.
Yeah, you got it.
Oh, sorry. Jonathan, look at the time. We gotta jump back to the office. Thanks, Kelda.
Bye, boys.
Bye.
Johnson, what took you so long?
Well, I had to walk here. So.
Oh, excuses. You know what do you some good? Wrapping up this lesson for me.
You know what? Gladly.
All right, well, I've got some very important work to attend to, so I'll leave it to it.
Well, everyone, let's review what we learned today. Number 1. What are the 2 most common types of crop insurance? Number 2. How do they work? Number 3. How do you process a claim? And number 4. What are the strengths and weaknesses of each type of insurance? Nathaniel, I gotta tell you, I've had a great day.
Good to hear, Johnson.
Thank you for having me.
I'm gonna get back to my work now.
Okay, all right, well, I'll just leave.
Ta-ta!
Yeah, I'll go. Okay, I'll go.
Madly, because you held me tight.